Welcome back to No Fear Equity. In the last lesson, we linked up with Mike LaPlante, a veteran startup attorney from Perkins Coie, to break down the first section of a Series A term sheet. In this lesson, we'll go a little bit deeper and break down the next section of our term sheet, the charter. All right, let's get into it.
So there are a bunch of rights that are just inherent in preferred stock. So when you do your first round of financing and you issue preferred stock, it's going to come with some of these ubiquitous rights. Most of those rights are set forth in the charter. And this here is just sort of a description of what those rights are. The first of those is a dividend preference. It's pretty unlikely you're ever going to be issuing dividends, but if you do, in the future, you're going to have to give some to the preferred holders before you give some to yourself. One of the key features of any series or class of preferred stock is a liquidation preference. That means that when you have a liquidity event, there's a preference for your preferred holders to get paid before the common stock holder. If you have a great exit, it's usually pretty irrelevant. Everybody converts to common stock anyways. But if you don't have a great exit, this liquidation preference can really bite you. There's not much to negotiate here. It's pretty ubiquitous across investments. There's a couple other things here. All preferred stocks convertible into common stock. Usually in a good exit, all that preferred is going to convert into common. There are some anti-dilution protections that are built into preferred stock as well. But what I really want to focus on are these protective provisions. So this one's a little bit different than the pre-money valuation because there's usually not a ton to negotiate here. What protective provisions are? This is going to be a long list of things here that you're going to have to go to your investors to have them approved before you're able to take those actions. Usually when you raise a Series A round, Series A investors like to get somewhere between 15 and 25% of your company. But anything that's going to affect that ownership percent is going to have to go through these investors before you can do it. Mostly big things like selling your company, raising another round of financing, anything that's going to dilute them beyond what they already bargained for. The primary things that investors are going to be interested in protecting is their financial interest. So anything that's going to affect their financial interest in your company, they're going to have a blocking right. And that's what you're seeing here. You're seeing a list of all the actions that you're going to have to go to your investors for in order to get approval. The first one is winding up the company or having what's called a deemed liquidation event. That's an exit. That's selling your company, having an IPO, or just winding the company down. Amending or restating your certificate of incorporation or your bylaws. Once that's settled, they don't want you changing it without their approval. Future financings, creating or authorizing the creation of additional securities that are senior to this round. You can't raise additional capital without the approval of your investors. Redeeming stock, that's one that's not going to happen that often, but it's on the list. Taking on a lot of indebtedness, this is one where there is some wiggle room in your negotiations. Sometimes we see this on the list, other times we don't. But for the most part, your investors aren't going to want you taking on a bunch of debt without their approval. Increasing the amount of shares available under your plan, or increasing or decreasing the size of the board of directors. Those are pretty much ubiquitous in any term sheet. Sometimes folks will ask for more. Sometimes you'll see a little bit shorter of a list, but these are things that you should expect. And again, not a ton of wiggle room in terms of negotiation.
Okay, so there you have it. Now that we've broken down the charter section, in the next lesson, we'll join Mike as he dives even deeper into the agreements that come after the charter. We'll start with the first two agreements, the stock purchase agreement and the investor rights. For more resources on everything related to startup equity and fundraising, check out our website, Carta.com. Thanks for watching No Fear Equity. We hope you found it helpful, and we'll see you on the next one.